to the Hughes Optioneering Weekly Workshop, where we scientifically engineer trades for greater profit potential. This is the disclaimer slide. You can pause to read it. We're going to move on. Today we're going to look at MOD, or Modine Manufacturing Company. MOD operates primarily in a single industry consisting of the manufacture and sale of heat transfer equipment. Hey, has a mind of its own tonight. Thanks for your patience. The BarChart.com technical opinion rating for MOD is a 100% buy, with the strongest short-term outlook on maintaining the current direction. Long-term indicators fully support a continuation of the trend. According to Prime Trade Select rules, a stock is in a bull trend on a monthly basis if the stock price is above the 10-period or 10-month simple moving average. The chart shows that MOD is well above the moving average line, so the monthly trend in MOD is up. Next, we're going to look at the daily chart. A stock is in a bull trend on a daily basis if the 50-period or 50-day exponential moving average is above the 100-day exponential moving average. The blue line is the 50-day EMA line, and the green line is the 100-day EMA line. The chart shows that the blue line has been above the green line since the chart started in October, so the daily trend in MOD is up. Next, we're going to look at a daily chart that displays the Keltner channel. As a rule, we don't want to buy calls if the stock price is above the upper Keltner channel line. Anywhere inside the Keltner channel or even below the Keltner channel is fine. MOD is below the upper Keltner channel line, so MOD is inside the buy zone. Since the trend is up, we want to buy a call. MOD has 5 option chains to choose from. We're going to use the April 19 option chain. Right now, the April 19 options have 34 days to expiration. Here's the MOD option chain for April 14. MOD closed at 88.57 on Friday. That means any calls on the list from 35 to 85 are in the money. Let's take a look at the profit potential for purchasing the MOD 90 strike call. Whoops, I marked the 95. Anyhow, we're going to look at the 90 strike call. The bid-ask spread for the 90 call is 460 to 560. We tried to enter at the midpoint, so we'll use 510 as the buy price. Yes, we did get it right. Our call option calculator shows the profit potential for this call based on MOD price changes at option expiration from flat to a 12.5% increase in price. We can see that if the MOD stock price is flat at 88.57 at option expiration, the 90 call will lose 100% of its value. Ouch, that's an unacceptable risk. That kind of loss can wipe out a trading account in a hurry. We developed what we call the 1% rule to help us avoid this kind of risk. The 1% rule says to limit the time value portion of the option we buy to 1% of the stock price. That means the stock only has to move up 1% for the call option we purchase to break even and start profiting. Now let's take a look at buying the 80 strike call to see if it qualifies for the 1% rule. Here's the call option calculator picture for the 80 call. According to the 1% rule, we want the call to at least break even if the stock price is up 1%. The calculator picture shows that if the MOD stock price is up 1%, the 80 call will lose 16.7% of its value. We want that to be break even or better, so the 80 call does not meet our requirements. Let's see if the 70 call will work. The bid-ask spread for the 70 call is 730 to 22 even. We tried to enter at the midpoint, so we'll use 1935 as the buy price. The 70 call works. If the MOD stock price is up 1%, the 70 call will make a 1.1% or $21 profit. That's better than break even, so the 70 call is the one we'll buy. The call option purchase calculator also shows that if the MOD stock price increases by 2.5%, the 70 call will make a 7.9% or $154 profit. If the MOD stock price increases by 5%, the 70 call will make a 7.9%. I'm sorry, I'm lost. Okay, we're going to go back. If the MOD stock price increases by 2.5%, the 70 call will make a 7.9% or $154 profit. If the MOD stock price increases by 5%, the 70 call will make a 19.2% or $377 profit. If the MOD stock price increases by 7.5%, the 70 call will make a 30.5% or $599 profit. The 10% and 12.5% numbers are also displayed. You can see that the profits get better and better. And notice that if the MOD stock price does not make the expected move up and remains flat at expiration, the 70 call would only lose minus 3.5% or minus $68 compared to the minus 100% or minus $510 loss for the 90 strike call that we looked at earlier. Now we want to review a call option debit spread, aka a vertical call spread. For this spread, we want to buy to open the MOD April 19 expiration 75 strike call and sell to open the MOD April 19 expiration 85 strike call. We're going to base our entry prices on the midpoint between the bid and ask prices. That means we'll buy the 75 call for $15.20 and sell the 85 call for $7.65. $15.20 minus $7.65 equals $7.55. So the entry price or debit cost for the spread is $755. The call option spread analysis calculator picture shows that the spread will make a 32.5% or $245 profit if the MOD stock price declines by 2.5%, remains flat, or increases in price when the options expire. If MOD is down 7.5% at expiration, the trade will lose 8.2% or $62. Creating the debit spread will allow us to collect a $765 cash credit to our brokerage account for the sale of the 85 strike call. As we said on the previous slide, this reduces the cost of entering the spread to $755. Here's a note regarding earnings reports. The next MOD earnings report is scheduled for April 30. Let's review the trades one more time. The first trade was a call purchase. It said to buy to open the MOD April 19 expiration 70 strike call for $19.65. We also reviewed the spread. The spread said to buy to open the MOD April 19 expiration 75 strike call and sell to open the MOD April 19 expiration 85 strike call at a debit of $7.55. That's it for this week's Optioneering Workshop. Thank you for joining us. We look forward to seeing you again next week.